Hello, people of YouTube. This is Mike of DividendGrowthInvest.com, and today we're going to talk about dividends. Specifically, what are stock dividends and why should we care? I run a blog discussing the dividend growth investing strategy. See the link below for more details, but today we're just going to focus on the basics. You probably heard the term dividend from time to time, but what are they and why are they important? Well, dividends can be a fantastic way to generate passive income. This passive income can be best defined as cash flow received on a regular basis, requiring minimal effort to maintain it. So basically, that means you earn money in your sleep. Gaining sizable amounts of passive income from multiple sources is a pathway to financial independence. Independence, where you can enjoy life stress-free and keep collecting money, or parlay those earnings into other business ventures to become very wealthy. Unfortunately, having a good job just isn't enough. Actual wealth accumulation usually happens by owning quality businesses and having multiple income streams. One way to accomplish this is by buying quality stocks that pay dividends. Dividends represent a share of the company's profits paid out to stockholders. These payments are decided on by a board of directors and typically paid out by more mature companies. Dividends can be in the form of cash payments, which is the most common form, shares of stock, or other forms of property. When investors look at dividends, they typically start with the yield. The dividend yield is computed by dividing the annual dividend payment by the company's share price. The earnings not paid out to shareholders are known as retained earnings. Typically, a company doesn't pay out all earnings as dividends. Retained earnings are needed to reinvest in the company and further grow profits. Which brings me to an example, the Coca-Cola Company, ticker symbol KO. As of early 2018, Coke is trading around $43, $44 a share and has a dividend yield of approximately 3.5%. This means if you buy one share of Coca-Cola, you will receive 39 cents every 3 months until the dividend payment changes. In this case, Coke pays out quarterly, so every 3 months. Some companies pay annually, biannually, and even monthly. Obviously, the more shares you own, the more cash you will receive. So if you have 100 shares, you multiply those 100 shares times 39 cents a quarter times 4 quarters annually. Presumably, if the company continues to be successful, those payments will continue to rise. This is only 5 years of Coke's history. The company has paid out rising dividends for the last 55 years. We all know Coca-Cola as a gigantic beverage company with a diverse product line. They're not going anywhere anytime soon. The company has been in business for over 100 years and paid out a quarterly dividend since 1920. They've raised the payout every year for more than 55 years, making them a dividend king. Even more remarkable, Coke paid out during the Great Depression and increased the payout more recently during the 2008-2009 financial crisis. So just to give you a little bit of an idea of what the returns would have been on Coca-Cola over the past few decades, if you reinvested these dividend payments, $10,000 invested in 1988 would have turned into $337,274 today. Also, Coke is a top holding of investing guru Warren Buffett. A dividend growth investing strategy has to do with finding quality companies that pay out these cash dividends. Reinvesting these dividends can manifest incredible returns and an ever-increasing passive income. A strategy that, in my opinion, is a great way to become financially independent. So with that in mind, I leave you with a quote. If you don't find a way to make money in your sleep, you will work until you die.